Welcome to Finivize. Is my money safe? That's the question on many bank customers' minds amid the global banking crisis. Not even after the shocking failures of Silicon Valley Bank, Signature Bank, and Silvergate Bank in recent weeks, along with the takeover of Credit Suisse, though the Swiss bank's issues are very different from what took down the US regional banks. Nevertheless, they are things to be scared of. Ensure you watch this video to the end, as you will be shocked to discover you can't rely on the FDIC if another financial crisis hits and your bank goes under. Or haven't you ever paused to ask if the FDIC has sufficient funds to keep up with its promises? Let's go over the recent global banking crisis in a nutshell. A bank run on Silicon Valley Bank prompted the Federal Deposit Insurance Corporation to shut down the bank on the 10th of March 2023, which happens to be the second largest bank failure in US history. 2 days later, the FDIC also took over Signature Bank. Though the FDIC covers deposits up to $250,000, the majority of the depositors of these banks are huge companies and startup firms, which means they had a lot more than that in their accounts. According to SVB's most recent annual report, American clients had at least $151.5 billion in uninsured deposits in 2022. Foreign deposits worth over $13.9 billion are also not insured. Notwithstanding, the government took an extraordinary step, assuring customers would have access to all their money, even their uninsured deposits. Silvergate Bank, a cryptocurrency-fused bank, became the latest victim of the ongoing crisis in the industry after announcing plans to wind down operations and voluntarily liquidate. Silvergate Bank's collapse was triggered by the collapse of FTX, which led to a devastating bank run. Its failure had more to do with crypto and a huge error in judgment by its management. Could this be the start of another Great Depression? The Great Depression of 1929 to 1939 started with a series of bank failures. In a bid to manage the bank crisis that was happening then, in 1933, the Federal Deposit Insurance Corporation, FDIC, was established. Some economists and historians believe that the kind of bank failures we had before 1934 is very unlikely to occur again, because the US created deposit insurance. The Banking Act of 1933 empowers the FDIC to safeguard consumer bank accounts through deposit insurance. Even at that, what happened in 2008? Bank failures during the Great Recession, 2007 to 2009. During this period of the economic downturn, much fewer banks collapsed compared to the time of the Great Depression. Between 2008 and 2015, roughly 500 bank failures occurred, according to the FDIC, whereas almost 4,000 banks failed in 1933. Although bank accounts were insured by the FDIC, the Great Recession did not have the same impact on depositors like the Great Depression had. Depositors today never lose a penny, even beyond the legally protected deposits, because when a bank fails, the FDIC looks for acquiring banks and transfers all deposits to the acquiring banks. This happened during the 2008 financial crisis, explains Charles Calomiris, a finance and economics professor at Columbia Business School. This brings us to the question of how safe your money in a bank is. Deposits made into bank accounts are safe as long as your financial institution is federally insured. The FDIC and National Credit Union Administration, NCUA, oversee banks and credit unions respectively. These federal agencies also provide deposit insurance. When a financial institution is federally insured, your money deposited into a bank account will be secure, even if the financial institution shuts down. Your money won't go down with the bank. Money is usually transferred to another FDIC-insured bank, or you get a check. Of course, federally insured bank accounts include savings accounts, checking accounts, money market accounts, and CDs. Individual bank accounts are insured up to a specific account. Before you get stressed out about your money in the bank, you need to understand that as an individual, if you have less than $250,000 in an FDIC-insured American bank account, you almost certainly have nothing to be concerned about. Each bank account owner is covered up to $250,000. However, if you have a joint account with your spouse, your money is insured for up to $500,000. If you bank with a federally insured credit union, your deposits are guaranteed by the National Credit Union Administration, just like the FDIC, which is backed by the credit reserve of the United States government. Deposit protection is also available to banking customers in Europe. In the UK, depositors can have up to £85,000, $102,484 refunded to them if their bank fails, with the amount increasing to £170,000, $204,967 for joint accounts under the Financial Services Compensation Plan. The FSCS is funded by an annual tax paid by financial services firms, including banks. For bank customers in the European Union, should their bank shut down, they are guaranteed a refund of €100,000, $105,431 of their deposits under a deposit guarantee scheme funded entirely by banks. Joint account holders are eligible for a total refund of €200,000, $210,956. While in Switzerland, the FINMA regulator insures Swiss deposits of up to 100,000 Swiss francs. Where should you keep your money? According to Jay Hatfield, CEO at Infrastructure Capital Advisors and portfolio manager of the InfraCap Equity Income ETF, it is not advisable to take all your money out of a bank, but make sure the FDIC insures your bank. At this stage, negligence can be so costly. It's expedient that you have insured depositors, no matter the amount. If you have $1 million, why not split up your money between banks or 4 different deposit accounts in the same bank and have them insured? It is a wake-up call for people to always make sure their money is at an FDIC-insured bank and within FDIC limits and following the FDIC's rules, says Matthew Goldberg, a bank rate analyst. As much as this professional advice from experts may sound compelling and reassuring, the collapse of these banks is a good reminder to be aware that systems and structures can fail at any time. The shocking truth about the FDIC and your bank deposits. Do you know why you can't rely on the FDIC if another financial crisis occurs and your bank shuts down? Millions of US bank depositors feel safe and unbothered knowing that the Federal Deposit Insurance Corporation will protect their accounts, even if their bank fails. Absolutely, the FDIC stated that. According to their website, the standard insurance amount for each account is $250,000 per depositor in an insured bank. But the question is, does the FDIC have the resources to keep its commitment? In the event of a major financial crisis, the answer is a capital no. In August 2008, towards the peak of the 2007 to 2009 financial crisis, the Elliott Wave theorist stated, "The FDIC is not adequately funded to bail out even a tiny percentage of America's largest banks. It has just enough money to pay the deposits of 3 major banks. After that, it goes bankrupt." No doubt, most people will be shocked to know this. But come to think of it, how can a single company insure all of the deposits of the entire bank in the country? Yet that FDIC sticker on the front of your bank is very reassuring. Your banker's lectures concerning your deposit insurance can be so convincing. Another shocking, less encouraging declaration came from the former vice chairman of the FDIC itself. In an article he wrote for the Los Angeles Times, December 18, 2014, captioned, "FDIC can't finance a big bank bailout without taxpayer support." In case you've forgotten, during the financial crisis in 2008, Congress had to pass a special law to fund a $700 billion bailout. The Federal Deposit Insurance Corporation had nothing close to enough resources to fund their resolution. With roughly $11 trillion in assets and $4 trillion in derivatives, the 8 largest US banks are significantly larger and own far more derivatives than in 2008. Compare those figures to the $54 billion FDIC insurance fund. These are eye-opening statistics. Theoretically, the banking sector should be more stable due to the regulatory reforms put in place after the crisis in 2008. But here we are again, with multiple banks collapsing in a single month. Who knows what will happen next? The best way to protect your deposits is to thoroughly research the banks in your area and select one whose personnel handle their customers' deposits prudently. Because as an individual, it would be nearly impossible to know when a big bank is failing. To identify the red flags, you will need to keep track of the bank's financial statements, regulatory filings, audit reports, etc. Moreover, most of the information that will help you accurately assess the health of your bank, such as deposit inflows and outflows, credit losses, and funding sources, are not publicly available. Besides, these reports are only published at the end of each quarter. Yet it takes less than 72 hours for a bank run to happen. So if a bank runs into trouble, It's often those with access to the bank's inner records who are going to see it first. They would have taken the needed smart moves before the entire public. As you can see, it is a fallacy that the FDIC will always guarantee your bank deposits. Bank runs are a normal occurrence in the economic cycle. Even at that, thinking of them can be so scary, and history is very likely to repeat itself. Enjoy this video? Now watch this.